clearly the results, the returns from financial markets across the world have been generally positive. And that's strange because we've had plenty of challenges so far this year. We've had worries concerning inflation still. We've seen higher interest rates. We've still had sad geopolitical matters to consider. We've had strange stuff from politicians and the like. There's plenty of challenges out there still. But as we've talked about earlier this year, markets have generally been quite good. If you look at the average UK equity performance, and even for most parts of the bond market, generally it's been a positive total return, which is a little bit different from what many people were expecting at the start of the year. And certainly when you consider we now had therefore 6 months of at least a workable backdrop for an average investor involved in the financial markets, it certainly is pleasing compared to perhaps some of the thoughts from certain points of last year where there were huge concerns about a matter of issues, be it geopolitical or be it somewhat closer to home. It's clearly patently something which has correctly worried people, because if you're worried about a bank or the concept of a bank, then clearly that's a concern that could impact everything. Fortunately, the problems have been centered in other countries, predominantly America and a little bit in Switzerland, which is a strange and unusual choice of many of us, I guess. British banks have generally been absolutely unaffected. And my view, I guess my uppermost view on this is that I can expect that to continue. So don't worry about your bank. You don't need to have all the money under your bed or something. Keep it in your bank or invest it or related. Your question though, Rob, is a good one, which is, what is all this saying to us? Is there some kind of problem or issue out there? Because we can all remember times in 2008, and older people like myself, even before then, when banks have had all sorts of issues. Reality is banks are better run than they were in previous times, but inevitably, as we can see in all aspects of life, there are people and organizations that do it better than others. And some banks have been a bit silly because some things have changed in recent years. We've actually seen now interest rates go from near zero to something, and the interest rates aren't particularly high, but that sort of shift from a very low level of interest rates to what we would regard as a normal level of interest rates always has an impact on things like banks. Plus, of course, you've had bank lending. If you think about how, and this, I'm talking particularly here about the bank in California, which had a range of problems. If you go through the economy over there, the bunch of interesting technology companies with very clever businesses, some of which are inevitably not going to work, they've had a bunch of special issues as well, which perhaps the bank lending model wasn't smart enough or clever enough. You put all of those issues together, volatility, new volatility in bond yields, some certain bank lending requirements not being closely followed, certain banks have had a problem. As I said to you though, the uppermost view for the average British investor is most British banks are well run, and actually in terms of the kind of the assistance and requirements that how a bank is managed, we're not going to lose our money. We will always be able to get access to it and related. And if we were going to have a problem, believe me, the issues that you saw between 2007 and 2009 is times 10 what we would expect today. So we've done all the bad stuff already, and it's finally worked now. So don't worry about it from that perspective. But as an organization, should banks be learning from some of the issues over recent weeks? Absolutely. But fortunately, I think the average British bank has made those lessons and had those lessons too many years ago to remember. Okay, so bonds, if we think about what a bond is, obviously we can have government bonds, we can have corporate bonds, anybody can borrow money. There's one good thing about a bond and one less good thing about it. The good thing about a bond is, of course, it is, in theory, a slightly more boring investment than an equity, because you should be paid beforehand, you get a dividend from it, and unless a company or a government goes bust, you are likely to get that. The negative, though, is that things do change and have changed. And if you think about the last few years, what have we seen? We've seen higher interest rates, and back to what we were just talking about, the banking sector, certain things have changed a lot more than people have been used to for much of the last decade or 15 years or so. So consequently, bonds correctly are showing that there is more potential risk out there. The risk of an individual company or even a government going bust is a little bit higher than it would have been a couple of years ago. And so therefore, a bond has done the right thing, which is, and the way that I was taught many, many years ago about bonds, the critical thing to remember is when a bond yield goes up, the amount of dividend effectively it pays you, the price goes down. And so what we've seen over the last couple of years is that bond yields have gone up, reflecting those higher risks, and hence bond prices have gone down. Now, as an investor, what this has meant is bond returns have been a bit shabby compared to the previous decade, or actually, to be honest about it, the last 40 odd years. Bond yields have generally been going down and down over that period. So things have got trickier for the average bond investor. But I think we're at that point now where a good amount of risk is now priced in. What matters is, and it sort of comes around to this rather boring way of looking at bond markets, when you look at the risks out there, you're now a bit more realistic about it. I would say the way to think about it is the fact that I imagine the rate of inflation is going closer now to where we will see bond yields being. So I'd say when we look at things like UK bonds, government bonds and related, they're a bit more fairly valued today, which is, from an investor's perspective, where it should be. We should expect to see bond yields at about 3-4%, and we should expect to see inflation at about 3 or 4%. And that is sort of fair value in an old way of thinking about it. So I think bonds are going to be fine in the sense that they'll pay you your yield. It's the yield better than what we saw a couple of years ago, but your total return from it will only be about what a bond should be, about the rate of inflation over the medium term. And you shouldn't expect to make any more money than that. So stable, relatively stable, but not highly remunerative. That is what a bond is all about, mostly. By contrast, the equity markets, the other part of the sort of the broader areas that our portfolios look at, equities and bonds being the two core areas, equities have that greater risk, but that scope for potential higher return. And I would still say, if I think about the rest of the 2020s, my guess would still be that equities are probably offering you the greater growth, total growth scope, dividends plus growth of share price, higher than bonds in terms of the total return from them. As an investor, which one should you have? You should probably have both. That's always been the correct thing to do. That split, though, this is where people like yourself, Rob, are highly skilled and knowledgeable about, is that finding that correct split depending on where you are in your personal investment story, age profile, requirements, and everything else. I think, though, the most important thing for all investors to understand, though, is that bonds are not riskless and they should offer you a yield. And I think a couple of years ago, we got to the point where bond yields were so low, interest rates were so low that actually it had to change. And that's what we've seen. So are bonds super exciting, must have? No. They're not the, oh my goodness, everything is fantastic, this is where all our investments should be. Absolutely not. But as part of a mix of a portfolio, it does now have a rationale to it. And I think it will, at worst, cover inflation, which is not a bad place to start for a portfolio. Yeah, it's an interesting question, isn't it? I actually thought the budget, all budgets are interesting to look at, but I actually thought it was actually a relatively dull budget, which is probably a good thing. We all remember two highly excitable mini budgets back 6 months or so ago. Putting that aside, the budget was sort of as expected. In terms of what it was doing or saying, actually the UK is worryingly similar to many other countries with similar sort of broad profile in the world today. Countries which have been, are relatively, in the wider scheme of things, relatively rich, relatively established, aging populations and the like. The challenges for all those countries, the UK being clearly one of them, is that governments are going to need to raise more tax. They have an aging population which they want to provide services and assistance for, and that has an impact, be it individuals in terms of the tax that we pay, or a company in terms of the tax that it will pay. So there is going to inevitably, it doesn't matter whether you're talking about parts of Europe, the States, Japan, many other countries around the world, you're seeing very similar occurrences happen. So to me, that's why the budget was highly as expected. And I'm afraid to say we should expect to see a continuation of this over the rest of this decade. Now, from an investment point of view, there are two sort of considerations here. One is that if people think that, oh my goodness, I want to invest in companies that only invest in low tax, high growth countries, then there are ways to try to do that. You probably would have a greater allocation to the emerging markets, as we call them, countries that are a slightly earlier stage of their economic development. But believe me, it doesn't matter whether you look at countries in Asia or South America or Middle East, all countries are facing sort of slowly the same challenges and issues. People are living longer, fortunately they're wealthier, but new challenges are occurring. So I would say it's not really something that you can say, right, I want to do this in order to avoid. It's not something to worry about too much. The world is still, as I often say, the world is still getting better, thankfully. Here's the other thing though, the big positive about the UK. The UK is inherently an international country. For many reasons, history and everything else, be it the location of where the UK is in the global time zone, many other matters. And being a global company is a massive positive. Because the thing is, as the world gets a bit more complex, hopefully a bit richer, a bit smarter and everything else, having that position, be it because of all those reasons, is a nice thing for the UK and for the average UK company. And as we've talked about before, it doesn't matter whether we're investing into a UK listed stock, it often is very international in terms of its orientation and where it makes its profits and related. So a long answer, but it's a complex and important factor. I'm afraid tax is going up, but it's not a disaster, is what I'm trying to say, be it at a personal level or even an investment level. Does it stop you living your life or continuing to do what you want to do, or making your investment choices ultimately successful and giving you everything you want from that? Absolutely not. It just makes things a little different. But we know that as investors already, and we can predict that and try to find ways around that in order to minimize some of those challenges and focus on the more important factor, which is trying to access stable, excitable, medium-term growth, which is something we're all interested in, hopefully. It is a global issue, and it's something which globally everyone's aware of, means people shouldn't try and panic or say, oh my goodness, we need to put all the cash under the bed and hope everything's going to be okay. When people start saying that to you, you know that actually you should always be doing the opposite to it in any case. So don't panic too much. Enjoy the Easter period and hopefully the better weather. That's a far more important thing to be focused on over upcoming weeks and months, no doubt.